Hello everyone. Today we will discuss some key insights from the book The Unusual Billionaires by Saurabh Mukherjee sir. This book explains how India's most successful businesses created wealth not with flashy ideas but with consistent execution, strong governance, and long-term thinking. These businesses did very simple things extremely well year after year. That discipline helped compounded their value over time. In this presentation, we will discuss some core lessons and principles about these unusual billionaires. Let's begin. My name is Harshil, and I will be talking about some business triggers that act as catalyst for growth for these businesses. The first one is government policies. Policy changes can transform industries completely. Uh, for example, the 1991 Liberalization Act opened India's economy to the world, which acted as an opportunity for global brands like Jockey to re-enter India with right players. The balance of payment crisis of 1990 and 1991 created a foundation for Axis Bank and HDFC Bank when government opened banking sectors to private players in 1994. The second point is geopolitical events. Large world disruptions may create an unexpected opportunities. For example, the ban on import of oil paints during World War II created an opportunity for local players to produce paint in India domestically. The Cold War changed the circumstances in the former Soviet Union, which led Dingra brothers to focus on Berger paints and created a growth story. The next point we are going to discuss is crisis which equals to opportunities. Crisis comes as an opportunity for well-prepared players. Uh, Labor strikes in the factories of TTK, Tentex, and crippling of associate apparels uh, created a vacuum for brands like Jockey to fill and cover the extra market share. The next point is strategic timing. Great businesses are known to act at the right time. The best example for this is Mr. Harsh Mariwala of Marico shifted from B2B to B2C business when he saw that the B2C business has comparatively and significantly higher profit margins. Next. Next, we will discuss about some business strategies that these businesses used in order to get successful. I will be starting with rural focus. The successful businesses realized that the growth was not limited to big cities. So when Mr. Champaklal Choksi was ignored by distributors in big cities, he moved to villages and small towns. He sold to consumers and shopkeepers directly who preferred affordable pricing and small packs. HDFC Bank acquired CBOP, that is Centurion Bank of Punjab, to establish its rural banking franchise. The next strategy is professional expertise. Businesses believe in changing from founder-led institutions to professional management. The best example for this is Marico appointing Marico Asian Paints and Berger Paints appointing the best IIM graduates in sectors for advertising, HR, etc. Axis Bank appointing Mr. Nayak, who was known the right person at the right time for the right job, and HDFC Bank roping in Mr. Aditya Puri, who was a prospective future for Citibank and who changed the fate of HDFC Bank. The next point we are going to see is dealer benefits. Dealers are not just channels, they are partners for the business. Businesses are known to give dealers regular incentives, trade discounts, rebates, and also reward them with a foreign trip in order to keep them motivated to achieve high sales target. Dealers are kind of a growth partner to the business. So when dealer grows, the business grows with them. The next point is supply chain management. The supply chain management helps to maintain the cost efficiently. For example, the Berger Paints uh, outsourcing its manufacturing in order to maintain inventory costs. Marico changing its packaging to make sure the transport of their goods easier and distribution easier, and Asian Paints delivering its dealers 4 times within a day in order to avoid stockouts. Now, wait, there are more business strategies to this, and it will be continued by my colleague Sid Shah.
Thank you, Arshil, for the opportunity. So, I would like to begin by saying that Saurabh sir has shown us that not all companies can survive through all the business struggles, but some of them have tackled them so brilliantly by using some brilliant business strategies. First is consumer-friendly packaging strategy. Consumer-friendly pricing focuses on reducing affordability barriers while maintaining value. A classic example is Asian Paints under Ashwin Choksi sir. When the company found that its products were perceived as expensive, it adopted a middle ground pricing strategy from the consumer's perspective. This strategy significantly expanded consumption, improved accessibility for middle and lower income households, and strengthened brand loyalty. Second is financial strategies. Strong financial strategies provide the foundation for expansion. Axis Bank used UTI's existing unit hold base to acquire customers, infused foreign capital to business to clean its balance sheets, and shifted its focus from corporate lending to retail banking. The appointment of an experienced leader, Mr. P.J. Nayak, boosted investor confidence and significantly strengthened the bank's credibility. These strategies resulted in financial stability, improved asset quality, and faster scalability. Third is celebrity endorsements. While most businesses in the book avoided glamour marketing, Berger Paints and Axis Banks used celebrity endorsement strategies. Berger adopted a modern advertising approach to refresh its brand image and gain mindshare, while Axis Bank used celebrity association to reposition itself as a youth and customer-focused bank. In both cases, endorsement acted as a catalyst for brand recall and customer acquisition, supported by strong execution and cost control. Next slide, please. Fourth is market expansion strategy. Page Industries expanded its market by understanding consumer behavior and improving distribution outside metropolitan areas. By offering diverse brands and affordable options, it penetrated various income segments while maintaining a premium brand strategy. Fifth is growth strategy. Growth strategy focuses on long-term scale and risk reduction. Berger Paints pursued growth through acquisition, expanding production capacity, and entering a new product segment. Marico, on the other hand, launched multiple new brands to reduce dependency on Parachute and focused on gaining market shares over short-term profits in the new markets. This diversification helped these companies reduce concentration risk, and ensure sustainable growth. Next is the other strategies used by the companies. For a platform strategy, Marico positioned Saffola as a heart health brand, shifting focus from product features to long-term wellness and enabling strong brand loyalty. Next is festival-based marketing. Asian Paints leveraged festivals like Pongal and Pola by offering small paint packages, creating seasonal demand and expanding rural sales. Next is brand mascot strategy. Asian Paints introduced the mascot Gattu to emotionally connect with middle-class consumers and improve brand recall. Last but not the least, insurance partnership strategy. Axis Bank partnered with National Insurance Corporation to offer low-cost accident insurance, increasing customer stickiness. On to the next topic, which will be explained by my colleague, Neet Kapaya.
Thank you, Sid. Um, so the markets reward those companies that not just grow, but have a sustained advantage in the market. The competitive advantage of a company refers to a specific capability of a company which is hard to replicate by other competitors. It can be in the form of technology, distributors, or partnerships. Ultimately, it allows the company to increase its pricing power and ROCE. Let us understand five competitive advantages here from the book and use a few companies as examples. Keep in mind here that the numbers only show the relative performance of the companies across the different and individual competitive advantages. The first one here is that of inorganic growth. Inorganic growth refers to the growth through mergers and acquisitions. It provides the company the capability to increase its market share and scale of operations. Marico here serves as a great example because it acquired several brands such as Nihar to increase its market share and become a large FMCG player. The second competitive advantage here is that of partnerships. These refer to the strategic connections with those companies that provide exclusive access to their products, technology, and patents. Astral Polytechnic serves as a great example here. Due to its connection with Lubrizol, it became the first company to introduce CPVC pipes in India. The third competitive advantage here is that of technology. Technology enables the businesses to improve their operations, efficiency, and customer reach. And there is no better example here for this than HDFC Bank. HDFC Bank used technology to create a centralized banking system, due to which it reduced the cost of funds and was able to obtain cash management business of the capital market players. The other companies mentioned on the grid have also used technology, but mainly for supply chain management and demand forecasting. The fourth competitive advantage here is that of business relations. Business relations, such as those with the laborers and distributors, help to maintain loyalty and prevent work related disruptions in the business. Page and Astral serve here as a great example due to their good and healthy relationships with laborers and plumbers, respectively. The final competitive advantage that we are going to discuss is that of distribution. The wider the distribution network, the higher is the product visibility for a company. And Axis Bank serves as a great example here due to its large network of ATMs and branches. The presentation will be continued by my colleague, Ashlesha Chauhan.
Now let's understand how this greatest company of India has done their capital allocation. So first is Asian Paint. So from the very first, Asian Paint main focus was on plugging back the money into their business only, which means whatever profit they have earned, they invest that in their business only. And they have done some backward integration also for the reduction of their cost. And they have tried some several service-oriented model, or we can say DIY model, which give consultancy in mom and pop stores. And our next company is Berger Paint. So from the very first, Berger Paint main focus was on increasing their brand value through advertisement or product innovation. And they have also done capex outside of country also, due to which they were able to increase their revenue. As we can see in a graph 1, their revenue was low as compared to Asian Paint from the year 2006 to 2011, because their main focus was on increasing their brand value. But after that, they have increased their revenue. Next slide, please. So next company is Axis Bank. So from the very first, Axis Bank was backed by a government entity named UTI brand, and due to which they were able to cater more and more corporate and retail customer. And they have their main focus was on expansion of branches and ATM. And our next company is HDFC Bank. So from the very first, HDFC Bank main focus was on catering the current account and saving account customer. There was a time when it take too much time to transfer money from one account to another. At that time, HDFC Bank has started doing centralized technology and solved this problem. And in return, they have even earned free fees. Now the next company is Page Industry. From the very start, Page Industry main focus was on their core business only. And even in a core business, they don't take up project if the project don't promise to give at least 20% of ROCE. And Page make capex decision based on assessment of business growth. This assessment includes subject like market expansion, product innovation, etc. Now the next company is Astral Poly. So from the very first, nobody want to accept the product of Astral Poly, which was CPVC pipes. But after being ties up with the Lubrizol, they were able to solve this problem. And they don't treat their employee as an employee, they treat them as a family, due to which they were able to create effective dealer network also. One thing was common between all this company, which was their main focus was on long-term expansion and growth, not on a short-term expansion and growth. Now I want Manan Arora to take a lead from here.
Thank you, Shlesha. So when we talk about innovation, we usually think of flashy products, aggressive marketing, or rapid expansion. However, as Saurav sir explained in the book, that the most successful Indian companies innovate very differently. Their innovation is not about headlines. It is about discipline, system, and protecting the capital across the business cycle. I will now show you how the Indian consumer and financial companies innovate not just to grow, but to survive and dominate over decades. Let me begin with Asian Paints, which is perhaps the best example of process led innovation in India. Very early on, it adapted the IT system for demand forecasting, something extremely rare in Indian manufacturing at that time. Dealer billings were fully computerized, which reduced the leakages and improved the working capital efficiency. Tinting machines were deployed at dealers' location, ensuring faster delivery. Berger Paints, on the other hand, offers an interesting contrast. Berger did not rush to adopt every innovation first. Instead, it followed a selective innovation strategy. It adopted tinting technology only after the model was proven viable by Asian Paints. Rather than focusing on being first, Berger focused on executing better at dealer level. Berger represented a company that innovates after risk is understood, prioritizing execution discipline over experimentation. Marico represent a different innovation path, that is the consumer-facing innovation. Marico successfully transformed commodities like coconut oil into powerful brand. It continuously innovated in packaging, usage format, and category positioning, thereby capturing consumer mindshare. However, in the case of Marico's, the period of over-innovation temporarily impacted their ROC. This refrained a key lesson from the book. Innovation must be capital efficient, not just consumer friendly. These consumer companies shows that the innovation is not one dimensional, but the book places even greater emphasis on quieter, more powerful form, institutional and corrective innovation. Next slide. So Page Industry demonstrate innovation through extreme process discipline. Rather than frequent product launches, Page focused on quality consistency, tight inventory control, and strong vendor coordination. This approach minimized the execution risk and protected the margins. Axis Bank Axis Bank's innovation lies in building robust credit appraisal, collection and monitoring system. Instead of chasing aggressive loan growth, Axis invested in framework that controlled downside risk. This aligned directly with Saurabh Sir's emphasis on avoiding balance sheet blunder. HDFC Bank is perhaps the strongest example of institutional innovation. Its conservative underwriting culture, rule-based decision-making, and system-driven leading processes ensures that consistency is over all decades. Innovation at HDFC Bank is embedded in culture, not dependent on individuals. This institutionalization is precisely what allows it to survive multiple economic cycles without compromising their asset quality. Astral Poly represent corrective innovation. The company scaled CPVC pipes nationwide but maintained their financial and process discipline. Rather than expanding across too many product categories, Astral focused relentlessly on their core SKU. This correction, focusing on what works the best, allowed Astral to grow sustainably while protecting their capital. To conclude, whether it is Asian Paint supply chain system, HDFC Bank conservative culture, or Astral corrective focus, the common thread is very clear that the true innovation compounds quietly, consistently, and across the cycle. Now I would like Tusha to explain the branding.
Thank you, Manan. I would now like to talk about branding and how it led to the success of these top eight companies. Across all the across all the brands discussed in the unusual billionaires, one clear pattern emerges that successful brands stopped selling products and it started selling emotions and outcomes. Most of these companies realized that brand recall changes as the consumers change, and as consumers became more aspirational, urban, and health conscious, the company communication was also evolved. Emotional connection was given more importance than features. Advertisement did not just explain CVPC ingredients or specs, but it instead communicated the end result like better hair, healthier life, success, and trust. For example, Sephora never sold oil, it sold heart health. Parachute never sold coconut oil, it sold care and nourishment. Celebrity led aspirational positioning. Celebrities were used not just for glamour but for aspirational alignment. Katrina Kaif for Burger Silk, highlighting elegance, premium, and modern Indian women. Deepika Padukone for Axis Bank, highlighting aspirational youth, confidence, and progress.
The celebrities became a shortcut to trust and recall, humanizing the brand instantly. Aggressive and consistent advertisement. Another repeated pattern is consistency. Ad spend increased year after year. Campaigns were run for every segment, and presence was everywhere in terms of TV, in store, and outdoors. This consistency ensured that even after consumers changed, the brand remained familiar. A very strong pattern across these companies is that advertisement was never episodic, it was always continuous. These companies understood that brand recall decays of visibility drops, so instead of short bursts, they invested consistently across years and not just quarters. This is why brands like Parachute or Axis Bank never disappear from consumers' mind and the visibility was always uninterrupted. Next slide, please. What's interesting is that advertisement alone didn't sustain these brands. Long-term recall came from discipline, experience, and credibility. Pricing and brand discipline. Many of these brands were extremely disciplined with pricing. No routine discounts, premium perception protected, and this shows that they valued brand equity over short-term volume. Distribution and packaging as branding. Branding didn't just stop at ads, it extended to shelves. Parachute expanded distribution aggressively, and packaging was updated as per the consumer's preferences. If the product is everywhere and it looks more modern, recall becomes automatic. Service led brand recognition. One of the most powerful insights is that some brands built recall without heavy advertisement. In examples examples in banking sectors is that brand recognition was driven purely by consumer services, first mover in service excellence, and here trust was replaced by advertisement. Customers experience itself became the brand. Leadership and reputation led branding. In some cases, the founder's reputation became inseparable from the brand. Sandeep's engineering credibility, stadium branding like Wankhede, and large scale visibility reinforced trust. People trusted the brand, and that trust transferred into the brand. Ultimately, brand recall is sustained when advertisement, experience, and credibility move together. Now, I'd like the next topic to be introduced by Harshit Toshniwal.
Saurav Mukherjee, sir, tell us about the architecture of few companies. Firstly, Berger Paints. Berger Paints builds a strong relationship with its dealers and distributor as they are the first customer for any paint company. They offers longer credit periods to dealers and painters. Axis Banks create a strong team of strong professional and independent board of directors. They created an employee-friendly culture and gave salary hikes to their employees and even introduced incentives like ESOPs. HDFC Bank reduced their risk and volatility by giving loans to blue chips companies. They diversified their loan books to many other things, many other loans like home loans, car loans, two-wheeler loans. Astral Poly ties create in Astral Poly done tie-ups with their plumbers where as they consider them as their customers. Employees of Astral Poly consider them as an family member of an Astral, which created a culture of loyalty and unity. Asian Paints hired quality personnel from top five business schools majorly from IIM. They Asian Paints IT streamlined processes, automated their manufacturing process, and increased their productivity. Their unique working culture nurture the talent of the employees. Each industry's relationship with built a strong relationship with labor as they were working in a labor intensive business. They have a strong tie-ups with their distributor. They have a process oriented approach in which they forecast their demand and track the productivity of their laborers. They interact with employees and motivate them to work hard to achieve their targets. Marico have an open work culture in which top management person sits in the cabins. They empower employees. They consult board of directors for the important topics, uh, especially for the board of directors. Thank you. The presentation will be continued by Krisa.
Thank you. As Saurabh sir said, based on the John Case framework, a strategic asset is an inherited advantage like a license, a network, or a partnership that competitors simply cannot replicate. These assets are deep rooted that have allowed these companies to generate superior return for decades. Let's start with manufacturing and distribution giant Asian Paint. Their Strategic asset supply chain domains. They operate over 125 depots and service 35,000 dealers directly. This efficiency is staggering and their revenue is more than double to their nearest competitor. Next is Bergerpain. Their asset is their physical footprint. By aggressively expanding plants to Jammu, Puducherry and Gujarat, they create a pan-India manufacturing network that drastically that lowered their logistic cost and delivery time. Then we have Marico. Their asset is the trade equity. They stop the industry practice of pushing unwanted stock to the dealer at month end. This built immense loyalty across their network, and they also developed the technology that allowed distribution to manage all their orders even from the competitors, making Marico as a indispensable. The power of exclusive right. Moving to the next slide. Page industry. Their asset is a unique legal relationship. In 2010, Jockey International renewed their license for 21 years until 2030, breaking the industry norms for standard of 5 years renewal. This effectively granted Page a monopoly on a global level brand in India, giving them access to global R&D without cost. Similarly, Astropoly had technology monopoly. They have sole license of Lucibel for all four of its CPVC brands in India. This gives an excessive market share uh, through the with the competitors, while competitors were still figuring out the basic. The financial fortress. Finally, let's look at the banking sector. HDFC Bank. Strategic assets is low cost and cost funding engine. By focusing early on transaction for stock exchange, they build a massive base of current and saving account. This allows them to source fund at cheaper rate than their peers, meaning they can lend safer borrower and still make the higher profits to maintain the growth and steadiness. Axis Bank built similar fortress through transaction banking. They have the highest current account deposit per branch among the large banks of rupees 191 million, driven by their dominance in government business and cash management. And Axis Bank has the strongest branch and ATM network of the banking sector. So now I would like to conclude the presentation that we clearly see from these companies that in long term success doesn't come from one big decision but from many consistent and well thought out choices over the time. They use the right trigger, invest carefully, focus not just on growth but on building strong system, brands and relation. Innovation for them was not about doing something flashy, but about improving efficiency, managing risk, staying relevant across the cycle by aligning strategies, culture, and execution. These companies were able to create durable competitive advantages, and the competitors found it difficult to replicate. Overall, this shows that sustainable leadership is built through discipline, adaptability, and long term vision rather than short term wins. Thank you.